Assalamu alaikum. Welcome to your first 5 money moves after school that you need to know. By implementing these 5 steps, you are going to set yourself up for financial freedom, early retirement, and having strong financial position for you and your family much earlier than other people who don't take these steps, inshallah. These are so powerful, and the biggest reason why it's powerful is because you have time on your side that other people simply don't. By taking these steps early on, having the effects of compounding and just really getting good habits in place early, you're going to be so set for success, inshallah. And the other point I want to bring up too is you either just entered the workforce or you're going to be entering it very soon, and realistically you're doing it for money. You're working for money. By having these 5 steps in place, you're going to have your finances set so that your money is also working for you. You're being clever with your money, okay? So inshallah, let's crack into it. Step number 1 is setting your goals, whether it's your personal goals, career goals, and of course your financial goals. Now, because you're at that crossroads in your life, you can take any direction, right? So you don't want to be going through life aimlessly. You want to have somewhat of a clear direction in place. Now, you don't have to have all the answers, of course, things change and you can find yourself with time, of course, but at least have an idea of what it is you want to do. Ask yourself those open-ended, serious questions and make sure that you're working towards something that really aligns with what you're after. And from a financial perspective, of course, you don't want to just be earning, spending, getting nowhere financially. You really want to set clear financial goals. And in order to do that, I do recommend setting SMART goals. So SMART being specific, measurable, achievable, relevant, and time-bound. So I've got a bit of an example here with a financial goal, something simple, like I want to save for my first car, okay? That's obviously a very broad goal, so we want to break it down and make it very specific. So number 1 being specific, I want to save $12,000 to buy a reliable second-hand car. You want it to be measurable, so I need to save $1,000 per month and track my savings in my bank account. You want it to be achievable, so I plan to manage my cash flow by working part-time, having a budget in place, and getting into that surplus cash flow position, which we'll touch on. You want it to be relevant. You don't want to have an irrelevant goal. You want it to obviously add value to you and get you ahead. So by having your own reliable car, it gives you that flexibility, and reducing travel stress also creates work opportunities as well, and having time with friends and family, which is such a the best part of your life, honestly, just those early years. And then being time bound as well. So by saving $1,000 per month over 12 months, that will get you towards that $12,000 savings target. So this just breaks things down, makes it super clear, takes out the grayness from it, and then that way you have that clear goal that you're working towards. We do have a halal wealth map, which is breaks things down a bit further and helps, prompt you to ask those questions to yourself as well, and really helps setting these in place. So it is on our website, so feel free to check that out. Now, step number 2 is managing your cash flow. Now, this is so important. In the later years in life, of course, I always say this is really the foundation of any financial plan for big reasons, but in particular for someone in your situation. Generally speaking, you're going to be in this beautiful financial position, generally speaking, of course, where, for example, if you're living with your parents or your guardians, that's generally going to bring down your expenses significantly. It's such a good time in life to live with parents and guardians, of course. And by not having, huge rent or a loan or anything like that to worry about, that's going to free up a lot of cash flow, basically. So even if you're on a starting salary full time, the fact is, because your expenses are going to be so low, you're going to have this huge savings capability. And by utilizing that towards things that are going to grow with time, that is the most powerful strategy. And I've worked with all different cohorts of people, from, people 18 years old all the way up to, in their 80s. And realistically, this period is typically where the biggest surplus cash flow is in play. And because you have that time and paired with that, there's huge potential, which we'll touch on, inshallah. So with your cash flow, step number 1 is opening your own bank account, of course. You want it to be in your name. And when you're looking for bank accounts, look for ones that charge no fees. I personally growing up my whole life as, throughout childhood, I was with Westpac and they were collecting $10 a month fees for 18 years. And eventually I cracked onto it and obviously removed that, but they obviously earned a lot from my savings over time. There are banks that don't charge any fees, so definitely look at them. And it just helps you manage your money independently. You get the app, you can look at it and be in touch with it. Number 2 is securing a steady income. Now, whether it is a part-time casual job, full-time job, whatever it may be, but just having a steady income stream coming in, so then that way you can plan your budget according to that, which ties into the third point there. So setting your budget early as well. So there are plenty of tracking tools available. We have a budget spreadsheet that I can send out to you. Just simply message us and we'll send that out. There's a lot of online tools as well, but basically you want to have a clear idea of what's coming in, your income, what's coming out, your expenses, and what's left over. Now you want to either get into, there's either a surplus position or a deficit cash flow position. Surplus meaning you are earning more than what you're spending, and deficit meaning you are spending more than what you're earning. So of course you want to get into that surplus position where you have extra cash flow and it's not getting spent. So that's the most important position to get into. And the reason why I bring this up again is because you are in that position potentially, Insha'Allah, where you can have a huge surplus cash flow, okay? Point number 4 is avoiding bad debt. Now, don't get into the habit of debt, your credit cards and Afterpay, and the habit of spending money that you don't have. It is so dangerous. And I've worked with clients where they are up to their eyeballs in debt and they struggle, and the financial stress that it causes is not worth it. And of course, from the Islamic perspective, we want to avoid it where we can too. So get used to having a debit card, and that is linked to that savings account that we mentioned, and just get used to the money that you do have, and that's what you have to spend, and work towards those goals. If you don't have enough savings yet, work towards it, but definitely don't get into that habit. And if you maintain this mindset throughout your life, you're going to get so much more ahead, inshallah. Step number 3 is sorting your super. Now, assuming that you have that steady income stream in place with your cash flow, you're going to have to be working, of course, right? So at that point, generally speaking, your employer is going to have to pay you superannuation. So getting in the right fund from the start, not just going with their default fund, is going to be very important for a few reasons. Number 1 is that the default fund for almost every employer is an industry fund or retail fund, and it's going to have underlying investments within it that are not permissible from the Sharia standpoint. It's going to have riba in there, it's going to have alcohol companies, tobacco, gambling, etc. And it's just how the system's built, unfortunately. So there are halal superannuation options, which I'll get into, but that's going to be very important, okay? So with these 2 steps here, how to sort out your super. Number 1 is making it halal, as I've mentioned. And number 2, setting it up in a way where it can actually really grow for you. And again, with that time on your side, these little differences can make hundreds of thousands of dollars of impact come retirement, inshallah. So how do we make your super halal? Well, ultimately superannuation in itself, there's nothing wrong with it. It's just a shell that holds your investments in it, and it's locked away until retirement. That's when you can access it. So the shell itself, there's nothing wrong with it. There's all different super funds out there. It all comes down to the underlying investments within that shell that determines the Sharia compliance of it. And as I've mentioned here, these traditional super funds, they typically do invest in haram industries, and we have to avoid it. So halal super funds, on the other hand, they avoid riba, which is the biggest one. And then, of course, they invest in companies that are involved in positive industries, not tied to earning money from, gambling and tobacco, banking, weapons, etc. Right? So that's going to be very important, not only from the Islamic perspective, but also morals too, right? You're earning this money. You don't want it to come from, pensioners gambling their money away or people dying from smoking cigarettes, etc. So it's a good ethical step moving forward that a lot of people don't realize till much later on. So it helps to get it right from the start. Now, in order to grow your super, there's these 3 simple tips to maximize your halal super fund. So Number one, looking for low fees, okay? So the higher the fees are with super, the higher the hurdle is, and the performance really has to get above that in order to get ahead over time. So they're all different super funds, they all charge different fees. Ideally look for one with lower fees where possible. And you want strong long-term returns, okay? So typically super funds are investing in things like the stock market and property. And generally speaking, these are long-term investments, at least 5 to 7 years plus over time. So if you can look at the super fund, look at the historical data and see how have they been performing. Anything, say, less than 8% over a longer period of time, I'd probably reconsider it and look elsewhere, because that's generally what the markets have done. So you want it to be at least in line with what the stock markets and property have done over time, ideally more than that if possible. And point number 3 is voluntary contributions. So these are things like your salary sacrifice and just making additional contributions into your superannuation fund. There's good and bad in it. The bad is that it is locked away until retirement, or if you're doing something like the First Home Super Saver Scheme, for example, for a deposit for your home, there can be benefit in that, but speak to an advisor first, of course. Honestly speaking, 8 out of 10 times I wouldn't recommend this particular approach, but just little differences, even if it's like $50 a month or whatever it may be, just those little additional contributions into super, because you have that time on your side, it can actually have quite a big impact. Now, step number 4 is building your savings, okay? So whether it is your emergency funds, which is a very important step, this is ensuring that you have about 3 to 6 months worth of living expenses in the bank, just in case anything were to happen, God forbid. That way you are looked after, and it's sort of like a self-insurance measure. Because typically your expenses will be on the lower end, this shouldn't be too big of a hurdle to save towards. The other thing that you should be considering is, going back to your first point, what your financial goals are. If it's to save for a car, and if it's going to be done in 12 months' time, well, perfect. Your bank account's going to be your best friend for that too. And it doesn't make sense to invest it over a 12-month period, okay? So going back to emergency funds, and then what your goals are, and then if those goals are, that short to medium term of, say, anywhere from tomorrow all the way up to, say, about 5 years' time, most likely your bank account is probably going to be the best tool to utilize that, or like a halal income fund of some sort. But basically, you want to make sure that you are saving towards those goals in place. And step number 5, which is really the most powerful one here, best for last, is start investing halal, okay? This is where the real benefits come in. Now, this isn't suitable for everyone. You want to make sure that those first 4 steps are sorted first. And before you do start investing, you want to make sure that your personal situation allows for it. Ask yourself why you are investing, which goes back to your goal generation. Understand that with investing, there's a risk and return relationship. So the more risk you take, the more return you should be compensated with, and vice versa. If you stash the money under your bed or in the bank account, not earning any interest, then of course, from that standpoint, you're not taking any risk. You don't get any return as well. So you've got to just factor that in, of course. And again, with the time frame. So as I mentioned, with investing, you do not want to invest money into the stock market or property if you have a time frame less than 5 to 7 years, okay? Because the value of these investments can go up and down in the short to medium term, and generally we're banking on the fact that over the long run, generally speaking, investments in these types of assets do go up over time, inshallah. And you've got to ask yourself how to structure the investments too, which is very important from a tax perspective. So always speak to an advisor first before taking this step. But this line in particular really, really applies to you. So we obviously all know Albert Einstein, and he's got this really famous quote on the power of compounding. So compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Now, that same concept of compound interest applies with compounding returns in the stock market and property. We obviously don't want to deal with interest there, but it's such an important concept to understand. And I've got a little graph here explaining a bit of a case study scenario here. So good thing about these types of assets that we invest in for our clients is there's a very low barrier to entry. It's not like buying an investment property where you have to save a couple $100,000. You can literally start with $1,000. You can technically start with literally $10 if you wanted to, right? But say if you started with $1,000, you made fortnightly deposits into your investments over time of $1,000 on top of that, just from your surplus cash flow that you did in step 2. From there, if you did that consistently over 20 years, earning 8%, which is what the stock markets and property have typically done historically over time, you can see here that the final projected balance is $1.28 million, okay? Starting with $1,000, ending up with $1.28 million. So that's easy $100,000 in passive earnings every year, which replaces your income, right? So potentially, by the age of 40, you have this huge investment vehicle there paying you passive halal earnings, and it's going to give you that flexibility where you can retire if you want, you can or even transition towards retirement, so start to live off that income and then continue to work part-time if that's what you want to do. You can gift it towards your children at that point as well, so they're going to have a huge starting, a huge head start compared to other kids, even putting it towards buying a house outright as well. So there's lots of different things that you can do. The point is that by investing over a longer period of time, that surplus cash flow, it's going to open up doors that wouldn't have normally been there, which is super, super powerful. Now, there's 4 key investment principles that I want you to factor in. So number 1 is taking that long-term approach. As I mentioned time and time again, at least 5 to 7 years plus. Whatever money you put towards your investments, think that, all right, this is for future me. I'm not going to need it, okay? Don't have it in your head where I'm going to need this in a year's time or something. Just put it to the side, almost forget that it exists. Number 2 is to buy low and sell high. So with investing, because it is our hard-earned money going into these investments, it's very natural for emotion to kick in when it comes to it. And as I mentioned, they go up and down. When they drop, our emotions typically tell us panic and sell, which is the worst thing you can do. Make sure that you are taking calculated decisions, logical decisions that align with your financial goals and your originally anticipated time frame. Okay, so when we buy investments, just like we buy our groceries or when we buy our electronics and whatever it may be, we always want to look for those discounts, right? So that same logic applies here too. We want to when markets drop, that's a fantastic buying opportunity most of the time. Okay, obviously assess the risk of it, but I don't want you to be freaked out if things drop. Think of yourself in a position where, okay, things are on sale, let's literally tidy up there. Let's clean up from that. Point number 3 is diversification. You don't want to put all your eggs in the one basket. So in order to invest halal, realistically, you need to diversify. And the best way to get easy diversification is at the start through halal ETFs or exchange traded funds. Now, it's a simple Google search, of course. If you need to speak to an advisor, definitely do it before investing in these types of assets. But there are some off-the-shelf halal ETFs available, and basically an ETF is a basket of many different investments. So, for example, we'll take one ETF as an example of the US stock market. Okay, so if you were going to buy into the US stock market, typically through an index fund, you're going to have to you're literally going to have to buy it through a regular ETF. But unfortunately, what's going to happen is you're going to buy that ETF and underlying assets within it. It's going to be, for example, 500 of the largest US companies. But the problem with that is of that 500 on regular markets, there's going to be alcohol companies and banks and everything like that in there. So there are off-the-shelf halal ETFs available where they filter out those haram companies, and of that 500, they'll filter out, say, 200, and you're left with 300 companies there in that basket. So you buy that one basket, you've bought 300 stocks in one simple transaction, and it's a very convenient way of getting that diversified exposure. So if one of those stocks go down, you've got the 299 to pick it up, basically. So that's just one very, very simple example. And number 4 is ongoing maintenance. So, markets always change, and there's different opportunities that pop up. There's different risks that pop up as well. So you always want to assess it and always make sure that, the current plan in place is current for your personal financial circumstances. For example, as your income increases, your savings ability might increase, so you can increase that as well. You know, so if expenses pop up as well, and always make sure that the investments are relevant for, you know, moving forward for the next 7 years plus, inshallah. Now that's a really, really brief summary, of course, but if you do want to speak to a financial advisor that specializes in this space, then definitely don't hesitate to reach out to us. As I've mentioned, we've helped clients of all ages, and you know, you guys are one of my favorite cohorts because of the potential that I see. We do the projections, we customize the plan for your particular circumstances and help you make those right first steps. So of course, this is general advice only. I didn't put this disclaimer video at the start because you would have clicked away straight away, but please consider this is general advice only. This is not personal advice. So it doesn't take into account your personal circumstances, financial situation or needs. Please reflect on it before acting on it, and always get personal advice first before taking these steps. Thank you so much for your time, guys. Assalamu alaikum.